In the long arc of financial history, every great crash starts with the same three ingredients: wild euphoria, stubborn denial, and the dangerously seductive belief that this time is different. Think back to 1929. America was buzzing, riding a massive wave of industrial transformation powered by electrification. The future seemed limitless. Fast forward to 2008. Cheap debt and rampant housing speculation created a powerful illusion of unstoppable prosperity. But what's happening right now, setting the stage for 2025 and 2026, is something historically unprecedented. Economists are calling it the everything collapse. For the first time ever, every major asset class is simultaneously trapped in a bubble. Stocks, bonds, and real estate are all inflated far beyond sustainable levels, all at the exact same time. This means that when the collapse finally begins, there will be absolutely nowhere to hide. Let's put this into perspective. A century ago, during the Great Depression, when stocks crashed a devastating 89%, bonds actually remained stable, acting as a safe haven for investors. In 2008, when the real estate market cratered, falling 35% below its long-term trend, the stock market, though hit hard, managed to recover within 5 years. But today is a completely different story. Global markets have been artificially inflated by trillions of printed dollars. Interest rates have been suppressed to historically low levels. And speculation is now supercharged by AI-powered algorithms. All the traditional safety nets are gone. And here's the most alarming part. Unlike previous crashes, this time, almost everyone is exposed. Today, 58% of all American households are directly invested in the market through their retirement accounts, their 401(k), IRAs, and target date funds. Compare that to 1929, when only about 10% of households had any stock market exposure. This isn't just a Wall Street problem anymore. It's a Main Street catastrophe waiting to happen. The moment of truth, the trigger, may have already been pulled. The yield curve, one of the most reliable recession indicators in history, uninverted back in September 2024. Historically, this event signals a recession is coming within the next 3 to 12 months. Meanwhile, the warning signs are flashing bright red across the board. The S&P 500 is trading at a price-to-earnings ratio of over 28. This level of valuation has only been seen twice before in modern history. Once in 1929, right before the Great Crash, and again in 2000, just moments before the dot-com bubble burst. It's not just stocks. Real estate prices are currently sitting 50% above their long-term trend line. To understand how extreme that is, remember that the 2008 housing collapse was triggered when prices were only 35% above trend. We are 43% higher than even that bubble level. At the same time, global bond markets are experiencing a level of volatility that has never been recorded since modern tracking began. And all of this is happening while the U.S. government sits on an astonishing $36 trillion in debt. That's over 125% of the entire nation's GDP. Just the interest payments on this debt amount to $1.2 trillion per year. To put that number in perspective, the United States now spends more money servicing its debt than it does on national defense, healthcare, or education. The scale of this is simply mind-boggling. In 2008, when the crisis hit, the Federal Reserve had a powerful tool. They could slash interest rates from 5.25% all the way down to zero to stimulate the economy. But today, rates are already near historical lows. Their other main tool, quantitative easing, which is essentially creating money out of thin air, has already been used to the tune of over $6 trillion since 2020. This has already triggered the painful inflation we've all been feeling. Using it again would be like pouring gasoline on a fire. The Fed is essentially out of ammunition. And unlike any time in the past, every single major asset class is overvalued, creating a synchronized vulnerability that our financial system has never faced before. Now, let's layer on even more risk. We have record levels of corporate and consumer debt. We have a commercial real estate cliff looming, with over $2 trillion of mortgages that need to be refinanced in the near future, but at interest rates that are 3 times higher than they were. The cracks are already showing. We've seen it in the failures of regional banks like Silicon Valley Bank, First Republic, Signature, and more recently, New York Community Bancorp. And what are the insiders, the people who know the system best, doing? They're getting out. Fast. Jeff Bezos has sold over $13 billion of his stock in 2025 alone. Mark Zuckerberg and other insiders from the biggest tech companies have been dumping their shares at a pace not seen even before the 2000 or 2008 collapses. At the same time, look at Warren Buffett, arguably the most successful investor of all time. He's not buying, he's hoarding cash. He's currently sitting on a record $325 billion in short-term treasury bills, a clear signal of extreme caution. His famous market valuation tool, the Buffett indicator, which compares the total stock market capitalization to the nation's GDP, is currently screaming danger. It stands at 185%, far, far above the 120% threshold he labels as the extreme danger zone. These are the exact same warning signs that appeared before 1929 and 2008. We see extreme wealth concentration at the very top. We see speculative mania gripping the public, with people chasing risky assets. We see margin debt at record levels. We see a false confidence in new technology, with today's chorus of AI will change everything, echoing 1929's belief that electrification would guarantee endless growth. And most dangerous of all, we see the widespread assumption that our modern financial systems are simply too advanced and too sophisticated to fail. So I want you to take a moment and think about this. Go ahead and comment below. Do you believe this 2025 to 2026 collapse can still be avoided? Or are we simply trapped in a historical cycle, a pattern of rise and fall that has repeated itself with every great empire, from Rome to Spain to Britain, and now, perhaps, the United States? Stay with me. Economic collapses don't happen overnight. They're not a sudden event, but the final stage of a long, predictable process. Throughout history, from the rise and fall of Rome to the decline of the British Empire, every major economic power has followed the same seven-stage sequence. It starts with dominance, moves to overextension, then to deficit spending, followed by currency debasement, runaway inflation, a devastating loss of confidence, and finally, total collapse. This pattern is not just ancient history. It's a roadmap. And according to a growing number of macroeconomic historians and top banking analysts, the United States has already passed through the first 5 stages and is now standing on the precipice of stage 6, the loss of confidence. Let's look at the evidence. The Roman Empire, in its final days, debased its silver denarius coin from nearly pure silver down to just 5%. They were trying to print their way out of a crisis, but all they did was destroy their currency and their economy. Fast forward to the 16th century. Spain, flush with the largest influx of silver in human history from the New World, thought its wealth was infinite. But overspending on wars and flooding the market with money led to massive inflation and 4 national defaults in just 40 years. Then came the British Empire. After World War II, crippled by debt, Britain lost its status as the world's financial superpower. The pound sterling was replaced by the US dollar as the global reserve currency at the Bretton Woods Conference. The empire on which the sun never set saw its economic twilight. Each of these empires believed they were different. They thought they were too powerful, too advanced, and too innovative to fail. Every single one of them was wrong. And now, all eyes are on the United States. We're told we're in a soft landing, that the economy is strong. But the historical parallels are becoming impossible to ignore. We've seen decades of dominance, followed by military overextension across the globe. We've witnessed deficit spending on a scale that would make Roman emperors blush. This led directly to stage 4, currency debasement, through quantitative easing, a modern term for printing money, which has diluted the value of the dollar. And as a direct result, we've lived through stage 5, the highest inflation in 40 years, eating away at our savings and purchasing power. This brings us to today, to the edge of stage 6, the loss of confidence. This isn't just a vague feeling of anxiety. It's a measurable, quantifiable shift. The yield curve, one of the most reliable recession predictors in history, has been inverted for a record amount of time. The lag effect from this inversion points to a precise window for a major economic event between December 2025 and September 2026. That's not a guess. It's a projection based on decades of historical data. The cracks are already showing everywhere you look. Regional banks are showing extreme fragility, a canary in the coal mine for the wider financial system. We're seeing the beginning of major commercial real estate defaults from giants like Brookfield and Blackstone. On the consumer side, the pressure is mounting. Credit card delinquencies are soaring. Auto loan defaults are at their highest level since the 2008 crisis, with over 7% of borrowers behind on payments. And student loan debt, a staggering $1.77 trillion anchor, is weighing down an entire generation. At the same time, geopolitical tensions are escalating, mirroring the late-stage imperial overreach seen time and time again. Conflicts in Ukraine, instability in the Middle East, and the standoff between China and Taiwan are not isolated events. They are symptoms of a global power structure under immense strain, a classic feature of the period right before a major shift. But what makes this potential collapse different from the ones in the past? Speed. When the market crashed in 1929, the decline was brutal, but it played out over nearly 3 years before it finally hit bottom. In our hyper-connected, modern world, analysts expect the next downturn to be far more violent and swift. Why? 3 key factors: unprecedented leverage in the system, high-frequency algorithmic trading that can trigger cascading sell-offs in microseconds, and extreme market concentration. Right now, nearly a third of the entire S&P 500's value is tied up in just 7 stocks. The Magnificent Seven. When one of these giants stumbles, the entire market could come crashing down with it. When the panic starts and liquidity dries up, there will be no safe haven. Internal risk reports from major institutions like JP Morgan, which are rarely seen by the public, paint a terrifying picture. Their models project potential drawdowns in a synchronized global collapse. Stocks could fall 65 to 80%. Bonds, traditionally seen as a safe asset, could drop 35 to 50%. And real estate, the bedrock of wealth for many families, could see its value slashed by 40 to 60%. The human cost would be catastrophic. Unemployment could surge to 15 or even 20%, dwarfing the 10% peak we saw during the 2008 financial crisis. And the recovery won't be a V-shape. Unlike the 5-year recovery after 2008, historical models based on empire collapses suggest a period of prolonged economic stagnation lasting 10 to 20 years, more like the Great Depression. Adding fuel to this fire is a massive demographic shift. 70 million baby boomers are now entering retirement. Instead of being net buyers of assets, they are becoming net sellers. They will be forced to liquidate their retirement accounts, their 401ks, their stocks, their bonds, into a declining market, creating a vicious cycle of forced selling that pushes prices down even further. So, can't the policymakers just step in and save us, like they did in 2008? This is the most crucial part. This time, they are trapped. Every potential solution is a poison pill. If the Federal Reserve raises interest rates to fight inflation, they risk crashing the markets and triggering a deep recession. If they lower rates to stimulate the economy, they risk reigniting hyperinflation. And if they resort to the old playbook of printing trillions more dollars, they risk a full-blown currency crisis, completely destroying confidence in the US dollar and mirroring the fate of Rome under Diocletian or Germany in the 1920s. There is no good option. There is no easy way out. That's what makes this situation potentially more severe than 1929 or 2008. It's not just the magnitude of the potential crash, but the lack of escape routes for those in charge. If history teaches us anything, it's this. Every empire believed it was the exception. Every empire believed it was too advanced, too powerful, too innovative to fail. And every single one was proven wrong. The question is not if the cycle will repeat, but when. So what can we do? The first step is to understand what's coming. Stay with me. In the next part of this video, we're going to break down the 3 early shock signals you must watch for during this 2025 to 2026 window. We'll also look at how individuals throughout history managed to protect their wealth and their families during similar periods of collapse. This isn't financial advice. This is history speaking loud enough for anyone willing to listen. Before we move on, I want to hear from you. Based on what we've discussed, where do you think we are in this 7-stage cycle? Comment below. Are we in stage 6, the loss of confidence, or are we already tipping into stage 7, the final collapse? Make sure you subscribe and hit the notification bell so you don't miss the next chapter, where history meets the future. Share this video with anyone you think needs to hear this message. Thanks for watching.